The closest way for you to generate true passive income, meaning money hitting your bank account without you going to work, without you doing anything while you're sleeping, is by investing your money into dividend-paying stocks or dividend-paying funds. But most people are doing it the wrong way. And in this video, I'm going to show you the different things you need to understand to really make this cash flow as a dividend investor. And the way that I'm going to break it up in this video is by doing three things. Number one, I'm going to explain what dividend investing is, how it works, that way you really understand why companies pay dividends, because if you don't understand this, you're never going to really understand how to find a good dividend-paying company, and most people completely ignore this. Number two is I'm going to talk about the cons of dividends, that we understand why there are risks to investing in money for dividends. And number three, I'm going to talk about specific funds that you can consider investing your money in to generate these strong dividends. So let me start by talking about number one, understanding dividends, why companies pay dividends, and how this plays a part in your investment portfolio. Because when you invest in a company on the stock market, you're not just buying a stock, you're buying a company. If you go out and you buy one share of the McDonald's Corporation, one share of the McDonald's stock, you are becoming one of the owners of the McDonald's company. Now, you don't get to tell McDonald's what to do with that small of ownership, but what you do get is a piece of their equity, a piece of the company, a piece of the ownership, which entitles you to a piece of the profits. Now, there are two ways that you can get paid these profits. One way is through stock price appreciation, and the other way are through dividends. If McDonald's starts to make more money, they start to sell more hamburgers, they grow more stores, and they're expanding like crazy, then more people might want to invest into the McDonald's stock. And if more people want to invest in the McDonald's stock, the stock price will go up. And if the stock price goes up another $100 a share, now your investment becomes more valuable and you have more money on paper. Now, of course, you don't actually make any money until you sell, but that's one way to make more money if McDonald's makes more money. If they make more money, more people want to own the stock price goes up, you make money on paper. But the second way you can make money is through what's called a dividend. A dividend is a profit distribution, which means that McDonald's sold so many hamburgers that they had a big amount of cash in their bank account. Now, one thing that they can do with this cash is they can reinvest it into the company. They can go out and find more franchisees. They can try to buy more land. They can try to create more hamburgers. But if they don't have a great investment for that money, then they might go to option number two, which is save this money for an emergency, because we never know when something bad might happen in the economy. We never know when McDonald's might get sued because somebody got sick because they ate a bad hamburger. And so they want to keep this cash reserves to protect them against this emergency. But if they already have cash reserves, or if they don't want to save any more money, then that leaves them with option three, which is give this money away to their shareholders. Because now if they have all this cash, they got to do something with it. If they reinvest it back into the company, they're trying to grow their profits. If they save their money, they're trying to protect the company against something bad. If they don't have any other use for that money, then they can just give it away. Now, there's a couple ways that they can give this money away to their shareholders. One way they can give it away is by buying up their own stock. It's called a stock buyback. Now, this is good in terms of stock appreciation, which is what I just talked about. Let's say you own a share of the McDonald's Corporation. Now, if McDonald's spends $1 billion buying up their own stock, what does that mean? That means there's a lot of buyers for the McDonald's stock. The company is buying up their own stock. Now, if you think about supply and demand, if you increase demand without changing supply, that means you have a lot of buyers without more sellers. The price of a thing goes up. So now, in this case, if McDonald's is buying up their own stock, that means the value, the price of the stock would be inflated. Why? Because a lot of people are buying up the stock. Who are the people buying up the stock here? Its own corporation. So when you hear of companies doing the stock buyback, they're deploying their cash, their extra money to buy back their own stock to cause the stock price to go up, which means you make money on paper. Again, you only make money when you sell, so it's on paper, but it increases the value of your investment. But the second way that they can give this money away to their shareholders is by doing something called a dividend, which is literally just taking this cash, let's just say $1 billion, and giving it away to their shareholders. People like you. And again, anybody can be a shareholder of the McDonald's stock. If you buy one share of the McDonald's company, you're one of the shareholders of McDonald's. And so now, if they have a big cash balance at the end of the year, they can pay out this dividend. And now you, as one of the owners of the McDonald's stock, get some of these dividends, get some of this cash deposited into your bank account. You don't have to sell the stock. You don't have to do anything. You're getting paid. Cash is hitting your account for doing nothing except owning the stock. It's a profit distribution. Think of it this way. You start a company. It's doing $1 million a year in revenue. Now, out of this $1 million, you have to pay $400,000 in operations costs. You got to pay your employees. You got to pay your rent. You got to pay your marketing costs, your product costs. And then you pay yourself a salary of $100,000. That means at the end of the year, you have $500,000 sitting in the bank account. Now, if you take $100,000 out of this $500,000 that's sitting in your business bank account and you wire it to your personal bank account so you can go out and buy a home, that is a distribution. That is a dividend to you. That's what McDonald's is doing on a much bigger scale, where they take this extra cash and they just give it away to the shareholders through this dividend. Which brings me to number 2, understanding the cons of investing your money in dividends. Now, I do want to let you know that if you are interested in investing in your financial education, my team at Briefs Media has a free ebook on how to build wealth as an investor that walks you through from the beginning of how do you build the mindset of an investor, to how do you start saving your money as an investor, to how do you start investing your money, how do you start generating cash flow, different types of assets that you can purchase, and how do you protect your assets. This ebook is completely free. And there's a ton of value in this ebook. So if you want to get a copy of this ebook for free and start learning and building your financial education, I'll put the link to how you can download this ebook for free down in the description below, that we can get a copy of the ebook and start learning, or you can go to briefs.co/ebook. Now, when it comes to the cons of dividends, the reason why some people are against this idea of investing in dividends is because of taxes. And the reason why is because anytime you make money, you have to think about taxes. And when you get paid a dividend, you got to pay taxes. Now, some people might say, well, if I make, let's just say $100 in dividends and I automatically reinvest this money, meaning I use this money to buy more of the stocks that paid me these dividends, do I still have to pay taxes on that? I mean, I don't actually see the money in my bank account. I'm automatically reinvesting this money through a DRIP plan, DRIP, a dividend reinvestment plan, which says that now anytime you get paid a dividend, you use this cash flow to buy more of the stocks that are paying you with dividends. And yes, you still have to pay taxes on that money, even if you don't actually use that money. And I'm telling you this as an attorney who's not your attorney. So this is where now understanding, okay, if I use this dividend money to buy back more stock, I'm going to have to pay taxes on this money. Would I be able to grow my money even faster if I didn't have to worry about taxes? Like, if I see this company stock appreciation, a company's not paying out dividends, but they're trying to grow faster, because now instead of paying out this money in dividends, they're taking this cash and they're reinvesting it back into the company. That way they can grow bigger, they can grow faster. Now my stock price might appreciate faster, meaning I might see my stock go from $100 a share to $500 a share, and I don't have to pay taxes until I sell, and maybe I don't sell until I'm older, so I can control my tax liability. But with dividends, I got to pay taxes every single time you get paid. This is a question for you. For me, I personally love investing for cash flow. The taxes are not a deterrent for me because I like that security. I like that comfort of knowing that I'm going to get paid whether or not I do anything. I like building these types of cash flow portfolios. That's why most of my investments, not all of them, but most of my investments are for cash flow. That's why a lot of my stock market investments are also for cash flow. So you got to figure out what's right for you. If you like the idea of generating cash flow through your dividends, that's one way to do it. But there are some downsides, such as taxes, because now that means the company is using that money unproductively. Because if a company is paying out billions of dollars a year in dividends, that means they're not using this money to grow the company. They're not using this money to make bigger profits. They're using this money to make their shareholders richer, which I'm okay with as long as I'm one of those shareholders. You got to decide what's right for you. The third thing now that I want to talk about are what types of dividend investments should you be making, with specific examples. And so now I'm going to switch gears a little bit. I'm going to pull out my whiteboard, that way we can go through some specific examples. So I'll see you over there. There are two ways that you can go out and start investing in companies that are going to pay you dividends. One is by investing in individual companies like the McDonald's Corporation. The other one is investing in funds that give you exposure to dividend stocks. So let me explain the difference. When you invest in individual companies, you're investing in one company. And there are a lot of ways that you can find these companies. Like, for example, this is an article from USNews talking about the best dividend-paying stocks. The top stock on that list is Verizon. Now, I'm not telling you what to invest in. I'm not a financial advisor. I'm just a random guy on YouTube. I'm just talking about the education so you understand how to make the best decisions for you. But this article, number one, has Verizon listed there. And the reason why it's listed at the top is because Verizon is going out and paying a strong dividend, over 7% according to that article, which seems great. But what you have to remember is what we were talking about in the beginning of this video. When you're going out and you're investing in dividend-paying companies, you're not just investing in the dividend. You are investing in the underlying asset, the underlying stock, the underlying company, the Verizon stock. And so now if we dig a little bit deeper into this company, take a look at this. This is a chart showing the Verizon stock over the last 5 years. And what you'll see is that over the last 5 years, the Verizon company has lost about 30% of its value. See, the problem that most people make when they're investing in individual companies for the dividends is they have no idea how to actually analyze the individual company. What they look at is the dividend that a company is paying. And if a company is going out and paying a strong dividend, they think that that's a good investment. But that's only part of the analysis. See, you want to invest in a good company that's not only going to pay out a dividend and then increase their dividend year after year after year, and then also see an increase in profits so the stock prices continue to rise. Because if you're investing in a company that's paying out a strong dividend, but the stock price keeps falling, well, you're losing the money that you're getting in dividends. And if you don't know how to analyze a company, if you're not interested in analyzing a company, if you don't want to keep up with individual companies, then maybe investing in individual companies is not the right way to go. Now again, there's a lot of different ways that you can analyze companies, from understanding the profitability of a company, the growings of revenues in a company, understanding who are the executives in a company. We go over this in the ebook that I have for you down in the description, but I'm not going to go over how do you actually analyze companies in this video. And there are tons of articles that you can read on how do you find a good company to invest in. I'll link the US News article for you down in the description. But what I want to focus on now are different funds that you can invest in, because these funds are now groups of companies, sometimes hundreds of companies, sometimes thousands of companies that are focused on just paying you strong dividends. Because now if one of the companies in these funds goes bankrupt, you're protected, because there are hundreds of other companies still paying dividends in that fund. And this fund can now kick out that one company and add in another company. That way you can keep generating your dividends. So if you want to make this more passive, you might want to consider investing your money into funds rather than individual companies, because, well, companies can go bankrupt, companies can fail, and yes, companies can succeed as well, but you're taking on all the risk by investing your money into an individual company. And if this is your retirement plan, this is your cash flow plan, you better make sure you're keeping up with these. And if you make a bad investment, all that risk is on you. Now, if you win, that benefit is for you as well, but you're taking on all the risk. And so if you're not willing to do the work, I personally would rather invest my money into funds if I'm not going to be keeping up with the companies. So let me highlight a few different funds that you can kind of consider to start your investment research. Again, I'm not telling you what to invest in, just a few ideas for you to consider. So here's a broad list of 7 different ETFs that are focused on paying you dividends. SPYD, SCHD, VYM, VNQ, VCIT, VYMI, and DHS. And let me break down each one. SPYD is the SPDR ETF. SPDR is the company that manages and creates this ETF. And what this focuses on is investing in high dividend paying companies that are within the S&P 500, meaning this fund focuses on investing in dozens of companies that pay dividends, but they're focusing on companies that are within the S&P 500, meaning the 500 largest companies within the stock market. So it's kind of a subset of a subset. First, it takes a look at the 500 largest companies in the stock market, and then within those, it looks at the dividend-paying companies, and then it picks dozens of companies out of there to invest in. And at the time I'm recording this video, SPYD is paying out an annual dividend of just under 5% a year. Then you have SCHD. This is an ETF created by Schwab. They're currently paying a dividend yield just over 3.5% a year. And what this does is it invests in a broad array of dividend paying companies on the stock market. It doesn't have that same requirement of investing in the same 500 companies, the 500 largest companies in the stock market. This is looking at the broad stock market in the United States, and it's investing in a number of high dividend paying companies there. VYM is a Vanguard ETF that focuses on investing in high dividend paying companies across the United States stock market. At the time I'm recording this video, VYM is paying out a dividend yield just over 3% a year. VNQ is another Vanguard ETF, and this one isn't focused specifically on dividends, rather is focused more on the real estate side, and many real estate companies are paying out high dividends. So through VNQ, you can get exposure to real estate and higher dividends. Right now, VNQ is paying out a dividend yield of just under 4.5% a year. VCIT is another ETF created by Vanguard, and this is an ETF that focuses on investing on corporate bonds, meaning this is focused on debt and generating interest from debt. And so that's where those dividends are coming from. So it gives you a little bit of a different type of exposure. These are talking about investing in companies and equities. This is talking about investing in bonds and getting interest from bonds, and that's where your dividends are coming from. At the time of me recording this video, this ETF ETF is paying just around 3.75% a year in dividends. Then you have VYMI, again, another Vanguard ETF. This is focused on investing in dividend-paying companies that are outside of the United States. So if you're looking for some diversification outside of the United States economy, outside of the potential United States dollar, this is a way for you to invest in companies that are outside of the United States that are paying out higher dividends. At the time we're recording this video, VYMI is currently paying right around a 4.5% dividend yield. And then you have DHS. This is an ETF created by Wisdom Tree. And again, this is an ETF that's investing in United States companies that are paying out high dividend yields. At the time we're recording this video, DHS is paying right around a 4.5% dividend yield. So now, this is where you can start doing your research. What types of companies do you want to invest in? Do you want them to be in the United States? Do you want them to be in a specific industry like real estate? Do you want it to be investing in debt? What types of companies do you want to be invested in? Do you want it just to be a broad United States company's dividends? And now, if you start investing in these types of funds, you have a little bit less work on your side because you don't have to go out and invest in one individual company. Once you find the right fund, now you can create a system where you just keep consistently investing your money in this fund, and you have a little bit less risk because, well, you have a lot of companies inside of one fund. And this is where if one company goes bankrupt, at least you have other companies inside of the fund to protect you. Does this mean it's completely risk-free? No, absolutely not. You always want to keep up with their investments, but you're lowering some of that risk. That way now, if you're trying to just create the cash flow for the rest of your life, well, if you're investing in funds, you don't have to worry about one company going bankrupt because you have more companies inside of that fund. So now that you understand this, let me know what your thoughts are on investing in dividends. Is this something that you're still interested in? And would you prefer to invest your money into these types of funds or into individual companies? That way you can help guide me on what types of videos that I should be creating. And again, if you want some more education, you can check out the ebook that I have for you down in the description. So if you don't have any money to invest, you can't invest your money. Now you might hear people on the internet talking about how you can invest your money with no money by trying to do this thing like stock trading or flipping real estate. Well, that's not investing. That's trading. Trading is a way for you to earn money. When you're trading, you're spending your time trying to get this income.